welcome. You're with Money, Money, Money. I'm Sumera Abdi. 2015 was a roller coaster ride for the Indian equity market. Well, for one, the benchmark indices hit all-time high only to come down. Commodity prices cooled, crude prices plummeted, and finally the much-anticipated Fed liftoff took place. Not just that, we've also seen the foreign fund flows dried up during the year, but only for domestic funds to come to the rescue. Let's take a look at the year that was.
Riding the Modi wave, the Indian stock market stepped into 2015 with huge expectations. By the end of 2015, equity markets disappointed. The Modi premium enjoyed by the markets in 2014 failed to sustain in the backdrop of weak earnings, dismal industrial pickup and foreign fund outflows, falling commodity prices and the parliament deadlock over the key GST reform.
Essentially, I guess the big concern still is growth is the missing element everywhere. So growth is missing in India, but growth is probably a bigger worry outside India. And that till that comes back, really, what you're playing is hope versus reality. That, okay, we hope that things are getting better, but somewhere every time earnings hits us, the reality is that, okay, this is not really panning out.
2, 1, bingo!
But it wasn't all gloom and doom. The primary market was on a secular uptrend with almost 13,000 crore rupees raised this calendar year. A sprightly jump from the 9,500 crore rupees raised in the last 3 years.
I definitely see that more and more good quality companies will hit the market, especially the companies where private equity investors invested in last 5-6 years, which are ripe for kind of hitting market. So you will see fairly large number of companies trying to raise capital, hit the markets, and I think that will be interesting opportunity as well.
And by December, the US Federal Reserve hiked rates by 25 basis points, thereby beginning the tightening cycle.
I think there's nothing to be too pessimistic about. I think come New Year, there'll be glad tidings again in the Indian market.
As we go along, as we head into next year, I think the fundamentals are reasonably strong to see some positive returns in the next calendar year.
So even if the street was let down in 2015, hopes from 2016 are aplenty. E-IPOs, for starters, will change the way primary market functions. The new listing regulations will bring in a lot more transparency and changes in the way companies disclose information. SEBI will see a new chairman in 2016. While 2015 was a year of net foreign outflows, India's growth will lead to foreign inflows chasing growth in 2016. Let's hope that the bulls, who are battered more often than not in 2015, stage a recovery back in 2016.
Wow, what a ride it's been. As we wrap up 2015 and step into 2016, one can only wonder what lies in store. Will there be surprises or will there be shocks in store? Well, let's speak to the man who has his finger on the pulse of the retail investor, Nimesh Shah, the MD and CEO of ICICI Prudential AMC. Hi, Nimesh. Welcome back to Money, Money, Money. And it's great because we spoke to you around the same time last year as well. So it's a great time to actually revise how 2015 has been and now what we can expect in the coming year. So the last year when we spoke, you had advised retailers to actually buy equity in 2015 with a 3-year horizon, right? Is that something you still hold on to? Because a lot of the retail investors that I've been speaking to, they get nervous despite market men like you being sanguine that, we're on track.
Absolutely. In fact, if you play my last year, I had said that 15-16, the corporate phone market is very fairly valued. What I said last year, I'll just start with repeating that 15-16 market is very fairly valued. So one should not expect returns from the market in the short term. But on a 3-year horizon, corporate profitability will grow. So invest in 2015 and 2016 to make money in 2017 and 2018. That's what I have been consistently saying since last 1 year, and I completely stand by that.
Okay, but it's nothing new actually, because the problem with retail investors has always been that, they always end up catching the tailwind, right? So despite fund managers over the last year saying buy low, sell high, or remain invested for the long term, we often don't see that translating into the retail philosophy. What's the case to be made to actually drill this down that, buy low and sell high is actually the way things are going to work, or long term is the way that equity is actually going to play out?
Sumira, what we have done, we have seen that when markets are at 29,000, the flows into the equity markets are maximum. People look at whether we like it or not. We have been saying do not invest based on past performance, but it's a fact that retail investors get very happy when they see past performance and they want to invest, and they get nervous when the past performance is not good. So their allocation to equity increases when the markets are high and decreases when the markets are low. That is the last thing to do in life. But that's how retail investors behave. So can we, as responsible AMC, can we create products which take out the emotions? Why retail investors does that? Because the emotions take charge of him while taking investment decisions. Investment decisions have to be taken without emotions, right? So when the markets are low, you should be able to buy, and when the markets are high, you should be able to sell. So what we have done at ICICI Prudential is that we have created a set of products which helps the retail investor to overcome investments. So we have come with products like ICICI Prudential Balance Advantage Fund, which will not, when the markets are at 29,000 or when the markets are high, when the price to book ratio in the markets are high, it will take the money, but 70% of that will get invested into debt, and only 20 to 30% will get invested into equities. So when the market corrects itself, as it has done now, the equity allocation will increase systematically.
Okay, so I'm going to actually press you on that a little bit more later on, but let's get to some of the other questions first. 2015 also we saw was the year of fixed income, right? I know you guys, you spoke about your balance fund, which also has a big exposure to that. Your recent report says that's an appeal that's going to continue also into 2016. So what should be the retail strategy then? Should it be duration funds? Should it be medium, long-term, accrual? What is the idea?
See, 2 years, one year back when I came to your program, I thumped the table and said that is a very good duration. Long duration funds are a very good investment. So now it is, I would say, interest rates have not come down as much as we had expected interest rates to come down. So clean, even after this, there is, while Raghuram Rajan decreased interest rates substantially, but it is not reflected in the 10-year government borrowings as much. Till today, 7.72 is the rate at which Government of India is borrowing. We believe in the next 1 year, it should come down by 50 to 75 basis points at least. So duration can be a good investment, but clearly a 3-year view. You should not invest, because less than 3 years it is not taxation efficient. So retail investor, whether he goes into duration funds, whether he goes into that corporate bond funds. So those kind of funds are ideally either you take accrual product, or you take duration product, or you take equity product. Anything into mutual funds with a 3-year paradigm, I think investors will have a good risk-return experience.
All right, that's fair enough, Nimesh. But let's take a break on that note. When we come back, we'll talk a little bit more about mutual funds and the investment strategy that you should follow in 2016. Stay tuned. We'll be back in just a bit.